the year. He is CNBC contributor Tom Lee from Fundstrat. He joins us now at Post 9. Welcome back.
Hey, Scott.
We got to stop meeting like this. I mean, honestly, you keep telling me things are going to be all right, Tom, and then the market doesn't do what you say it's going to do. I mean, I don't know what to make of it.
It's painful. I mean, I'd say anybody who owns stocks today feels like they're caught in like a vortex of downward misery. And I'm sure a lot of people are questioning their own sanity. I think Josh made some good points even about a stock like Disney. But I think before people start to lose too much hope, this week is interesting because the stock market declines have accelerated downwards, right? So we're like the waterfall is accelerating. But things that normally would corroborate a waterfall decline like yields or VIX have not been. So, you know, the bond market's actually been pretty stable even in the face of a hot CPI. And the VIX actually has been falling. So it looks like the market's actually short volatility.
Well, I mean, the VIX is still elevated. Let's not act like it's, you know, going down that much. It just, you know, it hasn't approached that level, let's say the 40, for example, that some talk about as the level you would like to or need to see to have a true capitulation sort of a feeling in the market.
Correct. But at the same time, the fact that the VIX is stable means it's found equilibrium, so that the level of protection that or expected vol that the market's looking for is now stable. And I think if you're getting negative surprises fundamentally and someone's trying to seek protection, the VIX should actually be spiking or rates should be falling. And instead, we just have the stock market selling up. So I think one thing that's going to stand out in the last couple of weeks is the fact that we declined 16% in less than 4 months. That's only happened 16 times uniquely since 1940. So it's not, we're in a different mode where I think it's not about fundamental now, it's a technical decline. But the good news is of the 16 instances, 12 out of the 16 times, the market was higher. 6 months later, average gain is more than double digit. And 15 of the 16 times, the market was higher. 12 months later, average gain's 20. So we're in a zone where if the market finds its footing, we're in a world of double-digit expected returns.
But isn't this, you say it's a technical led decline. Isn't it both? Isn't it fundamental and technical? I hear you on the technicals, but there are serious concerns about the state of the U.S. economy and the consumer going forward.
That's a great point. But let's say I was worried about earnings for the next 12 months, and so I want to buy companies that'll grow faster than GDP. I think we would all probably come back to looking at names like Microsoft, Apple, Facebook, and then we'd say, well, I want to buy these, but they're trading at below market multiples, Facebook at 11 times. And so I don't think it's investors necessarily worried about earnings, because if they were, they'd be buying stocks that have earnings visibility. I think it's pure, it's almost...
Well, they're in denial. What if they're in total denial? What if they're in as much denial as some of the analysts are who haven't taken their earnings projections down? I mean, isn't that the next thing to go?
Yeah, I think that's actually a good point. I think that the market is debating if this is a hard landing versus a soft landing or a growth scare. And I think in the past week, the betting is on a hard landing. And so if that's the case, then of course things could get a lot worse. I just would expect things like high yield to be getting crushed and spreads to be blowing out. And so it's almost a hard landing. It's getting priced into equities, but it's not as apparent in other markets.
So let me ask you a couple things, and then I got to go. Each day that passes and feels terrible and looks bad, and you close on the lows, and it's that slow grind, as Mike Santoli has suggested. Are you wavering at all on your call that we could still have a great second half of the year and finish 5,000 or so in the S&P? Are you wavering at all?
No. And I'm not trying to be stubborn, but to me, I would be worried if there was a leverage problem in the economy. You know, in other words, are consumers in huge trouble because they've borrowed too much, or businesses? That's not the case. But we know rates have gone up, so cost of capital has gone up. And I think we're just seeing all asset markets trying to reduce the prices of things that don't have high returns.
You've seen credit card debt levels, right?
Yes.
They're up, right?
Correct.
People have had to pay more for automobiles.
Yes.
Houses have been hard to come by. People have paid up for houses. Who knows if they use adjustable rate mortgages? I mean, I don't know if everything you're saying about the consumer being so strong is 1,000% accurate.
Well, Scott, again, the future is uncertain. But again, housing we know is a structurally short market because we underbuilt. And it will take some time to build enough homes. But that doesn't mean consumers shouldn't be buying a home. It's just the affordability is coming into question.
I'm talking about like the idea of all the leverage. Last thing, and then I really got to go. Your beef strategy, Bitcoin and Bitcoin equities for starters. Bitcoin's gotten taken out back and beaten up. And Bitcoin equities, I mean, I want to buy Coinbase? Really?
Yeah, well, unfortunately, the Bitcoin equities are beta to Bitcoin, and Bitcoin's been in a world of hurt. It's a high beta to risk assets. It's been tough to own, but again, Bitcoin's a hyper-volatile asset. Drawdowns like this have happened, so I don't think Bitcoin is down for the count, but it is in a tough spot.
And the FANGs. Bitcoin's so correlated to NASDAQ. Now, as Josh said, they're coming after the FANGs, or they've gotten the FANGs now. That doesn't concern you at all. It's a principal part of your strategy.
Yeah, the FANGs have been very disappointing in terms of equities. They're great businesses. I don't think they're going to be as hard hit in a growth scare, recession risk scenario, and the valuations are cheap. So I know they're crowded, and I think people want to get out of anything, and they're selling what they can sell. But FANG, to me, is an example of why the market is fundamentally offering good risk reward. They've gotten cheap.
Okay. We'll make that the last word. I give you credit. You show up, you answer the questions, and you give your opinion, and we'll see if it holds true or not, and we'll continue to ask you, and I think you'll continue to answer them. Thank you.
Great.
It's Tom
Thanks.
Lee from Fundstrat joining us now.